So when it comes to retirement, when you should change your investment allocations really comes down to how far out you are. What becomes vitally important is that first 3 to 5 years before you're going to make that transition, and then the 3 to 5 years after you've made that transition. That's when your investments are at their highest risk level. You just don't have enough time to recover if there is a big market crash, market correction. It's the same after you've already retired. You're right in the beginning of your retirement, and you really can't afford to take a big hit because you're no longer working, you're no longer saving, contributing to your 401ks. And so one rule that I came up with that I like to use to illustrate this is what I call the 24% rule. And when I say the 24% rule, I'm referring to 20% and 4%. That's what we have the potential to make. If we're purely invested in the S&P 500, we can make 20%. But what we have to understand is if we can make 20%, we can lose 20%. And when it comes to the income side of it, that's where we go to that 4% rule that so many of us have been taught and learned along the way, is that you can draw out 4% of your investments over your retirement lifetime and you won't run out of money. And so when it comes to when you should reallocate your investments, that's why it's so vital to start considering that equation, that 3 to 5 years before retirement, and keep that in mind as you transition into retirement and you're 3 to 5 years in, to make sure that you understand, if I'm going to risk 20%, I may win, but I may lose as well. So should I take the guaranteed, this is what I have now, what I know I can get, and can maybe take a little bit more risk down the road, right, as we get further into retirement.